Question 1. Which of the following is a primary objective of reinsurance? A. To eliminate all financial risk from the insurer. B. To provide insurers with a mechanism to transfer risk and improve solvency. C. To increase the profitability of the reinsurance company. D. To establish competitive pricing strategies for direct insurance products. Answer: B. To provide insurers with a mechanism to transfer risk and improve solvency. Explanation: Reinsurance is primarily used as a risk management tool by primary insurers. Its objective is to help insurers manage risk exposure by transferring part of their risks to another company, the reinsurer. This improves the insurer's solvency by spreading risk, allowing the insurer to cover large claims and meet regulatory capital requirements. Option A is incorrect because reinsurance does not eliminate risk. It simply transfers it. Option C focuses on profitability, but that is not the central purpose of reinsurance. Option D pertains to pricing, which is not the main function of reinsurance. Question 2. Mr. James, a reinsurance broker in Washington, is working with an insurer to place a reinsurance treaty. The treaty allows the reinsurer to assume liability for a percentage of the insurer's losses based on the insurer's losses over a specific time period. The reinsurer's payment is limited to set amount each year. This arrangement is known as A. Facultative reinsurance, B. Excessive loss reinsurance, C. Quota share reinsurance, D. Stop loss reinsurance. Answer: C. Quota share reinsurance. Explanation: In quota share reinsurance, the insurer and reinsurer agree to share a fixed percentage of the risks and losses from the policies written by the insurer. The reinsurer assumes a proportionate share of both premiums and losses. In this scenario, the reinsurer's payment is limited to a set amount each year, fitting the description of quota share reinsurance. Option A is incorrect because facultative reinsurance is a case-by-case agreement rather than an ongoing treaty arrangement. Option B refers to excessive loss reinsurance, where the reinsurer covers losses above a certain threshold. Option D refers to stop-loss reinsurance, which typically covers losses exceeding a specific percentage of the insurer's expected losses. Question 3. Which of the following factors should a reinsurer consider when assessing the risk of accepting a reinsurance contract from a ceding insurer? A. The ceding insurer's premium pricing strategies. B. The legal framework of the ceding insurer's home state. C. The ceding insurer's claim history and loss reserves. D. The ceding insurer's relationship with its primary customers. Answer: C. The ceding insurer's claim history and loss reserves. Explanation: Reinsurer evaluates various factors when deciding whether to accept reinsurance contract. The ceding insurer's claim history and loss reserves are critical as they provide insight into the potential future risk exposure and the insurer's ability to pay claims. The reinsurer needs to assess whether the ceding insurer's claims are predictable and whether sufficient reserves have been set for future claims. Option A relates to pricing, which is important but secondary to the insurer's financial stability. Option B pertains to regulatory concerns, but it is not the primary consideration for risk assessment. Option D focuses on the insurer's customer relationships, which are less relevant than the financial and risk management aspects of the business. Question 4. Which of the following is a key provision in a typical reinsurance agreement that directly impacts the reinsurer's financial obligations? A. The ceding insurer's right to change the terms of the policy at will. B. The limit of liability the reinsurer will assume under the agreement. C. The percentage of premiums retained by the ceding insurer. D. The reinsurer's obligation to conduct audits of the ceding insurer's financial statements. Answer: B. The limit of liability the reinsurer will assume under the agreement. Explanation: A critical provision in any reinsurance agreement is the limit of liability, which defines the maximum financial obligation the reinsurer will bear under the terms of the contract. This ensures that the reinsurer is not exposed to unlimited liability, protecting them from excessive claims. Option A is incorrect because the terms of the policy should be set in the original contract, not changed unilaterally. Option C is not relevant to the specific financial obligations of the reinsurer as it pertains more to the ceding insurer's share of premiums. Option D describes audit provisions, but these are typically for ensuring compliance, not for defining financial obligations. Question 5. In Washington, a reinsurer is required to hold a minimum amount of capital to ensure financial solvency. What is the purpose of this capital requirement? A. To ensure the reinsurer can absorb losses from reinsurance transactions. B. To allow the reinsurer to pay out large dividends to shareholders. C. To enable the reinsurer to provide liquidity for policyholders. D. To protect the reinsurer from inflation and currency fluctuations. Answer A. To ensure the reinsurer can absorb losses from reinsurance transactions. Explanation: the capital requirements imposed on reinsurers are primarily designed to ensure that the reinsurer can cover its obligations in the event of a large claim or series of claims. This ensures financial solvency and protects policyholders and ceding insurers. Option B is incorrect because capital is not intended to pay dividends but to maintain the company's ability to meet claims. Option C is not entirely accurate, as liquidity for policyholders is more relevant to the direct insurer. Option D relates to broader financial management but is not the core purpose of capital requirements in reinsurance. Question 6. Which of the following best describes the difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves the reinsurer covering losses above a set threshold, while non-proportional reinsurance involves sharing risks proportionally. B. Proportional reinsurance involves sharing risks and premiums on a fixed percentage basis, while non-proportional reinsurance covers losses that exceed a specified amount. C. Proportional reinsurance is used for large catastrophic events, while non-proportional reinsurance applies to smaller, more frequent claims. D. Proportional reinsurance is typically purchased by reinsurers, while non-proportional reinsurance is primarily used by ceding insurers. Answer B. Proportional reinsurance involves sharing risks and premiums on a fixed percentage basis, while non-proportional reinsurance covers losses that exceed a specified amount. Explanation: in proportional reinsurance, both premiums and risks are shared on a fixed percentage basis between the ceding insurer and the reinsurer. This means that the reinsurer assumes a specific portion of both the premiums and losses. Non-proportional reinsurance, on the other hand, involves the reinsurer covering losses that exceed a predetermined amount, e.g. excessive loss reinsurance. Option A incorrectly switches the definitions of the two types. Option C is incorrect because both types of reinsurance can be used for different types of claims, not just catastrophic or smaller events. Option D is not accurate because both types of reinsurance are primarily purchased by ceding insurers. Question 7. Which of the following statements regarding claims handling in reinsurance is true? A. The reinsurer typically has full control over the claims adjustment process under most reinsurance agreements. B. The ceding insurer is required to inform the reinsurer of all claims, regardless of size, under most reinsurance agreements. C. Claims handling is a responsibility exclusive to the reinsurer, with no involvement from the ceding insurer. D. The ceding insurer must settle claims before notifying the reinsurer of, under most reinsurance agreements. Answer B. The ceding insurer is required to inform the reinsurer of all claims, regardless of size, under most reinsurance agreements. Explanation: under most reinsurance agreements, the ceding insurer is required to inform the reinsurer about claims, regardless of their size. This ensures that the reinsurer is aware of potential liabilities and can properly manage its exposure. Option A is incorrect because the reinsurer typically does not have full control. The ceding insurer often retains primary control of claims handling. Option C is wrong because the ceding insurer is involved in the claims process. Option D is incorrect because the ceding insurer must notify the reinsurer promptly, not wait until after the claim is settled. Question 8. What is a cut-through endorsement in reinsurance, and when would it be used? A provision that allows the ceding insurer to cut off coverage for certain types of claims. B. An endorsement that enables the original policyholder to access reinsurance proceeds directly in the event of a claim. C. A clause that limits the reinsurer's liability for certain catastrophic events. D. An agreement that allows the ceding insurer to reduce premiums during periods of low claims activity. Answer B. An endorsement that enables the original policyholder to access reinsurance proceeds directly in the event of a claim. Explanation: a cut-through endorsement allows a policyholder to access the reinsurance proceeds directly, bypassing the ceding insurer if the ceding insurer is unable or unwilling to pay claims. This is used in situations where the ceding insurer faces solvency issues. Option A is incorrect because it describes a coverage exclusion, not a cut-through endorsement. Option C refers to a coverage limitation, not a mechanism for direct claims payment. Option D is incorrect because it refers to pricing adjustments, not to a cut-through endorsement. Question 9. In Washington, when evaluating the financial stability of A reinsurer, which of the following factors is least likely to be considered? A. The reinsurer's credit rating and reinsurance history. B. The reinsurer's compliance with state capital and surplus requirements. C. The reinsurer's relationship with policyholders and its claims settlement history. D. The reinsurer's advertising and public relations efforts. Answer: D. The reinsurer's advertising and public relations efforts. Explanation: while the reinsurer's credit rating, compliance with capital requirements, and claims history are critical in evaluating its financial stability, advertising and public relations efforts have no direct impact on financial stability or solvency. These efforts do not affect the reinsurer's ability to pay claims. Option A, B, and C are all vital factors in assessing reinsurers' financial health. Question 10. In a reinsurance agreement, a loss corridor is typically used to A. Set a maximum amount that can be paid out by the reinsurer for any single loss. B. Allow the ceding insurer to retain a portion of the losses within a specified range before the reinsurer takes over. C. Transfer losses from one reinsurer to another in case of excess claims. D. Limit the total amount of premiums that can be paid by the reinsurer. Answer: B. Allow the ceding insurer to retain a portion of the losses within a specified range before the reinsurer takes over. Explanation: a loss corridor is a provision used in some reinsurance agreements where the ceding insurer retains a certain amount of losses within the specified range. Once those losses exceed that corridor, the reinsurer becomes liable for the additional losses. Option A describes a different type of limitation, and option C refers to reinsurance between reinsurers, not the corridor mechanism. Option D is incorrect because it relates to premium limitations, not loss sharing. Question 11. Which of the following best describes the role of the Washington State Insurance Commission-owned reinsurance regulation? A. To approve all reinsurance contracts before they are executed by ceding insurers. B. To ensure that reinsurers maintain adequate reserves and comply with financial solvency standards. C. To negotiate reinsurance treaties on behalf of ceding insurers in Washington. D. To directly manage reinsurance claims and settlements for policyholders. Answer: B. To ensure that reinsurers maintain adequate reserves and comply with financial solvency standards. Explanation: the Washington State Insurance Commissioner's role is to regulate the insurance market, including reinsurance, by ensuring that reinsurers maintain sufficient reserves and adhere to financial solvency standards. This protects the financial stability of the reinsurance market. Option A is incorrect because the Commissioner does not approve individual contracts but rather oversees compliance. Option C is incorrect because the Commissioner does not negotiate contracts. Option D is incorrect because claims and settlements are handled by the ceding insurer, not the state regulator. Question 12. In a quota share reinsurance agreement, how is the risk and premium shared between the ceding insurer and the reinsurer? A. The ceding insurer and reinsurer share both risk and premium equally on a fixed percentage basis. B. The reinsurer assumes a set amount of the premium for every policy, regardless of the risks involved. C. The ceding insurer retains a fixed percentage of the premiums, while the reinsurer assumes a fixed percentage of both the premiums and risks. D. The reinsurer only assumes the premium for policies exceeding a certain loss threshold. Answer: C. The ceding insurer retains a fixed percentage of the premiums, while the reinsurer assumes a fixed percentage of both the premiums and risks. Explanation: in a quota share reinsurance agreement, both premiums and risks are shared proportionally between the ceding insurer and the reinsurer. This agreement specifies the percentage split of premiums and liabilities, ensuring that the reinsurer assumes a portion of the risk based on the premium received. Option A is incorrect because the sharing is proportional to the policies involved. Option B inaccurately describes how premiums are allocated in this type of arrangement. Option D refers to excessive loss reinsurance, not quota share. Question 13. Which of the following best describes the purpose of retrocession in reinsurance? A. To transfer risk from one reinsurer to another, often to reduce exposure to catastrophic events. B. To allow the ceding insurer to return premiums to the policyholder. C. To adjust the terms of an existing reinsurance agreement due to market conditions. D. To settle a dispute between the ceding insurer and the reinsurer over claims payment. Answer: A. To transfer risk from one reinsurer to another, often to reduce exposure to catastrophic events. Explanation: retrocession is the process by which a reinsurer transfers part of its risk to another reinsurer This allows the original reinsurer to manage its risk exposure and maintain financial solvency, particularly in cases of large or catastrophic events. Option B is incorrect because retrocession does not involve returning premiums to policyholders. Option C is not relevant as retrocession is a risk transfer mechanism, not an adjustment to agreement terms. Option D is incorrect because retrocession is about risk transfer, not dispute resolution. Question 14. Mr. Thompson, the risk manager for an insurance company, is reviewing a new reinsurance treaty that includes an excessive loss provision. The treaty states that the reinsurer will cover any losses exceeding $5 million. What does this clause mean for the ceding insurer? A. The ceding insurer must pay for all claims below $5 million, and the reinsurer covers any claims above $5 million. B. The ceding insurer is responsible for claims above $5 million, while the reinsurer covers the first $5 million of each claim. C. The reinsurer covers the first $5 million of each claim, and the ceding insurer covers anything above that. D. The reinsurer is not involved in below $5 million, but will pay for claims above $5 million. Answer A. The ceding insurer must pay for all claims below $5 million, and the reinsurer covers any claims above $5 million. Explanation: an excessive loss reinsurance agreement is designed to protect the ceding insurer from large losses. The reinsurer only becomes liable when a loss exceeds the specified threshold, $5 million in this case. The ceding insurer covers the claims below this threshold, while the reinsurer responsibility for any claims above the threshold. Option B and C are incorrect because they reverse the roles of the ceding insurer and reinsurer in relation to the threshold. Option D is partially correct but does not specify that the ceding insurer covers losses below the threshold. Question 15. Which of the following is a key factor in assessing the financial health of a reinsurer in Washington state? A. The reinsurer's market share and sales volume in the state. B. The reinsurer's compliance with regulatory solvency standards, including capital and surplus requirements. C. The reinsurer's marketing strategies and brand awareness. D. The reinsurer's relationship with the insurance broker handling the treaty. Answer: B. The reinsurer's compliance with regulatory solvency standards, including capital and surplus requirements. Explanation: to assess reinsurers' financial health, regulators focus primarily on its ability to meet solvency standards, including capital and surplus requirements, to ensure the company can cover its liabilities. Option A is not directly relevant to financial health and is more of business metric. Option C focuses on branding, which is unrelated to financial stability. Option D is incorrect because relationships with brokers, while important, do not directly impact financial solvency. Question 16. Which of the following is a benefit of using reinsurance for an insurance company? A. Reinsurance eliminates the need for an insurance company to maintain reserves. B. Reinsurance allows an insurance company to increase its underwriting capacity without significantly increasing its risk. C. Reinsurance guarantees a fixed return on investments for the insurance company. D. Reinsurance eliminates the need for an insurance company to pay claims. Answer: B. Reinsurance allows an insurance company to increase its underwriting capacity without significantly increasing its risk. Explanation: reinsurance enables insurance companies to write more policies, increase underwriting capacity by transferring some of the risk to reinsurers. This allows them to accept more business while limiting their exposure to large losses. Option A is incorrect because insurance companies must still maintain reserves regardless of reinsurance. Option C is incorrect as reinsurance does not guarantee fixed returns on investments. Option D is incorrect because reinsurance does not eliminate the ceding insurer's obligation to pay claims, but rather helps manage risk. Question 17. Which of the following best explains the role of treaty reinsurance in a reinsurance arrangement? A. Treaty reinsurance provides coverage for individual large losses, typically on a case-by-case basis. B. Treaty reinsurance involves a reinsurance agreement that automatically covers all policies of a ceding insurer within certain parameters. C. Treaty reinsurance is used to cover only claims arising from natural disasters and catastrophes. D. Treaty reinsurance is a one-time agreement covering a specific event or risk. Answer: B. Treaty reinsurance involves a reinsurance agreement that automatically covers all policies of a ceding insurer within certain parameters. Explanation: Treaty reinsurance is an ongoing agreement between the ceding insurer and the reinsurer where the reinsurer automatically assumes responsibility for a portion of the insurer's policies subject to the terms outlined in the treaty. It is typically not case-specific like facultative reinsurance, but rather applies to a broad range of policies. Option A describes facultative reinsurance, not treaty reinsurance. Option C is incorrect as treaty reinsurance can cover various types of risks, not just catastrophes. Option D is incorrect because treaty reinsurance is not limited to a one-time event. Question 18. Which of the following statements about the Washington State Insurance Commissioner's role in reinsurance is true? A. The Insurance Commissioner has the authority to approve or deny reinsurance contracts based on their terms. B. The Insurance Commissioner ensures that reinsurers comply with state-specific solvency and capital requirements but does not interfere with contract terms. C. The Insurance Commissioner negotiates reinsurance treaties between ceding insurers and reinsurers. D. The Insurance Commissioner is responsible for settling reinsurance disputes between parties. Answer. B. The Insurance Commissioner ensures that reinsurers comply with state-specific solvency and capital requirements but does not interfere with contract terms. Explanation. The Washington State Insurance Commissioner's primary role is to regulate the financial health of reinsurers, ensuring that they maintain adequate capital and solvency to meet their obligations. The Commissioner does not approve individual reinsurance contracts or negotiate between ceding insurers and reinsurers. Option A is incorrect because the Commissioner does not approve specific contracts. Option C is incorrect as the Commissioner does not engage in contract negotiations. Option D is incorrect because dispute resolution is typically handled through legal channels, not directly by the Commissioner. Question 19. Which of the following is a primary consideration when assessing risk for reinsurance purposes? A. The insurer's claims history and the consistency of loss patterns over time. B. The insurer's advertising campaigns and brand presence in the market. C. The insurer's relationships with brokers and agents. D. The insurer's employee satisfaction and organizational culture. Answer A. The insurer's claims history and the consistency of loss patterns over time. Explanation. When assessing risk for reinsurance purposes, the primary focus is on the insurer's claims history, which helps the reinsurer determine the potential for future losses. Loss patterns provide valuable insights into the types of risks the insurer is facing. Option B and C are unrelated to risk assessment as they focus on marketing and business relationships. Option D is also unrelated as organizational culture and employee satisfaction do not directly affect risk assessment in reinsurance. Question 20. Which of the following is an example of a facultative reinsurance? A. A reinsurance treaty that automatically covers all policies of a ceding insurer. B. A reinsurance agreement that covers specific individual policies or risks as they arise. C. A reinsurance agreement that covers all policies of a ceding insurer but with a fixed premium. D. A reinsurance agreement that applies only to catastrophic events exceeding a specified threshold. Answer. B. A reinsurance agreement that covers specific individual policies or risks as they arise. Explanation. Facultative reinsurance is a type of reinsurance where the reinsurer agrees to cover specific policies or risks on a case-by-case basis. This contrasts with treaty reinsurance, which automatically covers a broad range of policies. Option A describes treaty reinsurance. Option C refers to a form of treaty reinsurance with a fixed premium but is not facultative. Option D refers to excessive loss reinsurance, which is a specific type of reinsurance agreement but not facultative. Question 21. When analyzing a reinsurance contract, what is the primary purpose of the loss ratio in the context of assessing the reinsurer's performance? A. To determine the amount of capital reinsurer must hold to meet future claims obligations. B. To measure the percentage of premiums that the reinsurer paid out in claims. C. To assess the reinsurer's overall profitability from underwriting activities. D. To evaluate the reinsurer's compliance with state regulations regarding solvency. Answer. B. To measure the percentage of premiums that the reinsurer paid out in claims. Explanation. The loss ratio is a key financial metric in reinsurance that measures the proportion of premiums that a reinsurer pays out in claims. It is calculated as the ratio of claims paid to premiums earned. A higher loss ratio generally indicates that the reinsurer is paying out a large portion of its premiums in claims, which could signal profitability. Option A describes the solvency ratio, which focuses on capital requirements. Option C refers to the combined ratio, which evaluates underwriting profitability. Option D is incorrect because the loss ratio does not measure regulatory compliance. Question 22. Mr. Anderson is a risk manager at a large insurance company. He is considering purchasing reinsurance to help the company cover its catastrophic risks. Which type of reinsurance agreement would be most appropriate for Mr. Anderson to pursue? A. Facultative reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Surplus share reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed to cover catastrophic or high-severity risks that exceed a specified threshold. This type of reinsurance provides protection for losses above a certain limit, making it well suited for situations where the insurance company is concerned about large, unpredictable events. Option A is incorrect because facultative reinsurance is more suitable for individual risks, not catastrophic events. Option B is a type of treaty reinsurance that shares both premiums and risks proportionally but is not specifically designed for catastrophic coverage. Option D refers to surplus share reinsurance, where the reinsurer assumes a portion of the risk, but it is typically for smaller risks, not catastrophic ones. Question 23. Which of the following is a characteristic of proportional reinsurance? A. The reinsurer only covers losses that exceed a specified amount, usually related to catastrophic events. B. The ceding insurer retains a fixed portion of the premiums, while the reinsurer assumes a fixed portion of both premiums and losses. C. The reinsurer pays a fixed percentage of each claim regardless of the total loss amount. D. The reinsurer covers the first portion of each claim up to a specified amount. Answer: B. The ceding insurer retains a fixed portion of the premiums, while the reinsurer assumes a fixed portion of both premiums and losses. Explanation: proportional reinsurance refers to agreements where the ceding insurer and the reinsurer share premiums and losses in a fixed, predetermined proportion. The reinsurer assumes a portion of the premiums and the associated risk losses in proportion to the agreed upon split. Option A describes excessive loss reinsurance, not proportional. Option C is inaccurate because it oversimplifies how proportional reinsurance works. Option D refers to a different type of reinsurance, such as excessive loss or stop loss. Question 24. Which of the following is the most important factor when selecting a reinsurer for a treaty reinsurance agreement? A. The reinsurer's ability to provide comprehensive marketing support. B. The reinsurer's financial strength and ability to pay claims. C. The reinsurer's geographic reach and market share. D. The reinsurer's ability to offer immediate premium rebates. Answer: B. The reinsurer's financial strength and ability to pay claims. Explanation: the most important factor in selecting reinsurer is their financial strength, as it ensures they can meet their obligations, particularly in times of large claims. Financially strong reinsurer is better positioned to pay claims and provide stability to the ceding insurer. Option A focuses on marketing, which is not as critical in reinsurance. Option C relates to market share, which may be less relevant than the reinsurer's financial stability. Option D is incorrect because premium rebates are not typically primary consideration in reinsurance contract selection. Question 25. Which of the following describes a key difference between a facultative and treaty reinsurance? A. Facultative reinsurance covers a specific individual risk, while treaty reinsurance automatically covers a broad range of risks. B. Facultative reinsurance automatically covers all policies under the ceding insurer's book of business, while treaty reinsurance covers specific individual risks. C. Facultative reinsurance provides coverage for losses above a set threshold, while treaty reinsurance covers losses below that threshold. Facultative reinsurance is used only for catastrophic risks, while treaty reinsurance is used for all types of risks. Answer: A. Facultative reinsurance covers a specific individual risk, while treaty reinsurance automatically covers a broad range of risks. Explanation: the primary distinction between facultative and treaty reinsurance is the scope of coverage. Facultative reinsurance is arranged on a case-by-case basis, covering individual risks, whereas treaty reinsurance automatically covers a broad set of policies or risks based on the terms treaty. Option B incorrectly switches the characteristics of facultative and treaty reinsurance. Option C describes an aspect of excessive loss reinsurance, not facultative or treaty. Option D is incorrect because both facultative and treaty reinsurance can cover a variety of risks, not just catastrophic ones. Question 26. In Washington state, what is a requirement for reinsurers operating within the state to maintain their licensing? A. Reinsurers must have a physical office located in Washington state. B. Reinsurers must submit annual reports and undergo regular audits to demonstrate financial solvency. C. Reinsurers must have a minimum number of employees based in Washington state. D. Reinsurers must provide a guarantee of premium refunds to ceding insurers each year. Answer: B. Reinsurers must submit annual reports and undergo regular audits to demonstrate financial solvency. Explanation: to operate in Washington state, reinsurers must comply with state regulations regarding financial solvency, which include submitting annual financial reports and undergoing audits to ensure they meet solvency requirements. This is necessary to protect policyholders and ensure that reinsurers can meet obligations. Option A is incorrect because physical office location is not a requirement for licensing. Option C is irrelevant as the number of employees does not directly impact licensing. Option D is incorrect because reinsurers are not required to provide premium refunds. Question 27. Which of the following is typically covered by the stop-loss reinsurance? A. The first $1 million in losses for each claim, after which the reinsurer pays all remaining losses. B. The losses that exceed a specified percentage of the ceding insurer's total premiums or surplus. C. The losses that fall below set threshold, with the reinsurer covering claims within this limit. D. Only large individual losses that exceed set amount with no regard for the overall portfolio's performance. Answer: B. The losses that exceed a specified percentage of the ceding insurer's total premiums or surplus. Explanation: stop-loss reinsurance provides protection against losses that exceed certain percentage of the ceding insurer's total premiums or surplus. It is often used to protect insurers from aggregate losses that could affect their financial stability. Option A describes excessive loss reinsurance, not stop-loss. Option C refers to an incorrect description of how stop-loss works. Option D is inaccurate as stop-loss reinsurance is not focused on individual large losses but on overall aggregate losses. Question 28. Mr. Carter is evaluating a potential reinsurance agreement for his insurance company. He is considering a quota-share reinsurance arrangement where the reinsurer will assume 30% of both premiums and losses. Which of the following is a key feature of this type of agreement? A. The reinsurer only assumes losses above a certain threshold and the ceding insurer retains the initial portion of the loss. B. The reinsurer will assume a proportional share of both the premiums and losses based on the agreed percentage. C. The ceding insurer retains all premiums but pays a fee to the reinsurer for administrative costs. D. The reinsurer only covers specific risks identified individually, not the general proportion. Answer: B. The reinsurer will assume a proportional share of both the premiums and losses based on the agreed percentage. Explanation: in a quota-share reinsurance arrangement, the reinsurer and the ceding insurer share both the premiums and the associated risks losses according to a fixed percentage. In this case, if the reinsurer assumes 30%, both premiums and losses will be shared on that proportion. Option A describes excessive loss reinsurance, which is not proportional. Option C is incorrect because quota share involves sharing premiums and losses, not just paying fees. Option D refers to facultative reinsurance, where individual risks are covered, not a proportional share. Question 29. Which of the following is a primary concern when selecting a reinsurer for a treaty reinsurance agreement in Washington state? A. The reinsurer's ability to offer the lowest possible premiums for coverage. B. The reinsurer's compliance with Washington state's insurance regulations and solvency standards. C. The reinsurer's experience in marketing insurance products within Washington state. D. The reinsurer's geographical proximity to the ceding insurer's main office. Answer: B. The reinsurer's compliance with Washington state's insurance regulations and solvency standards. Explanation: when selecting a reinsurer for a treaty reinsurance agreement in Washington state, the primary concern is ensuring that the reinsurer complies with local insurance regulations, including solvency requirements. These regulations are designed to protect policyholders and ensure that the reinsurer can meet its claims obligations. Option A is incorrect because the focus should be on regulatory compliance, not just the cost of premiums. Option C is irrelevant, as marketing experience is not the key factor in treaty reinsurance selection. Option D is incorrect because geographical proximity does not impact the reinsurer's ability to meet its obligations. Question 30. In a reinsurance contract, what is the purpose of retrocession? A. To allow the reinsurer to pass on some of its risks to another reinsurer. B. To provide the ceding insurer with additional protection against high-frequency losses. C. To set aside reserves for future claims payments. D. To allow the ceding insurer to collect a share of the premiums from the reinsurer. Answer A. To allow the reinsurer to pass on some of its risks to another reinsurer. Explanation. A retrocession is a process where a reinsurer passes on part of its own risk to another reinsurer, often called the retrocessionaire. This is done to manage the reinsurer's exposure to risk and protect its balance sheet. It does not involve the ceding insurer directly. Option B is incorrect because retrocession is about managing a reinsurer's risk, not providing protection for the ceding insurer. Option C is related to reserve management, not retrocession. Option D is inaccurate because retrocession involves the reinsurer passing on risk, not collecting premiums from the ceding insurer.